Welcome to the tutorial on management accounting. Today the chapter is Throughput Accounting. Throughput accounting is based on the theory of constraints. Whenever there is a limited resources in production process, or whenever there is a bottlenecks in the production process, and whenever we try to follow the just-in-time production method, in that case we can apply this idea, throughput accounting. In throughput accounting, we try to maximize the throughput by identifying and eliminating bottlenecks. Here bottlenecks means any limited resources or any constraints in the production process. And since we try to maximize the throughput, what is throughput? Throughput can be calculated by deducting the direct material cost from the sales revenue. If we deduct the direct material cost from the sales revenue, then the result is considered as a throughput or throughput return or throughput contribution. In throughput accounting, we consider all the expense as a fixed expense. Only the material expense is considered as a variable expense. I am repeating, in throughput accounting, all operational expense are considered as a fixed expense. Only the material expense is considered as a variable expense, and whenever we deduct the material expense from the sales revenue, we receive throughput return or throughput contribution. And in our theory of constraints, we try to maximize the throughput by keeping the conversion and investment cost to a minimum level. In our theory of constraints, the main idea is to turn materials into sales as quickly as possible, so that we can maximize the net cash generated from sales. The basic idea behind the throughput accounting is bottlenecks. Bottlenecks means any limited resources or any binding constraint in the production process. The theory of constraints states that all times there will be a bottleneck resource or factor that sets a limit on the amount of throughput. It may be the sales demand, it may be any limited resource. That means the bottlenecks in the throughput accounting is known as bottleneck resources or limiting factor or any binding constraint or any limited resources by which production process hampers. We can see this is a process. Raw material is input, then we get the sales. In the middle of this production process, we can see we need to do material preparation, then we can see component preparation, and finally assembling. And we can see, suppose in our production process, our material preparation can do 100 units per hour. On the other hand, component preparation can do 50 units per hour. And finally, the assembling units can do 100 units per hour. In this production process, we can see here 100 units, here 100 units, but this component preparation, this process can only operate up to 50 units. That means it's a bottleneck, limiting factor or binding constraint. We apply this theory of constraint in our throughput accounting. There are 5 steps for dealing with bottleneck activity. The only way to increase the throughput is to increase the capacity of the bottleneck constraint. That's why all the focus of management attention should be on the increasing the capacity of the bottleneck resources or elevating the bottleneck. According to goal rate, there are 5-step process in dealing with the bottleneck activities. The step 1 is we need to find out which one is the bottleneck or constraint. Then we need to exploit, the highest possible output must be achieved from the binding constraint. This output must never be delayed, and as such a buffer inventory should be held immediately before the constraint. Then we can see we need to subordinate, operations prior to the binding constraint should operate at the same speed as it, so that work in progress does not build up. Here this is the bottleneck constraint, and the process of material preparation should continue with the same speed as like the component preparation, so that working process does not build up. That is the indication here. The operations prior to the binding constraint should operate at the same speed as to so that work in progress does not build up. And the fourth step is we need to elevate the system's bottleneck. Steps should be taken to increase resources or improve its efficiency. Suppose here it is the bottleneck resources, we should take measures so that the output of this component preparation is increased from 50 units to 100 units or any such output. And in the fifth step we can see return to step 1. We need to find out another constraint, because there may be any other constraint or bottleneck. In that case, the removal of one bottleneck will create another elsewhere in the system. That's why we should continue this process to ensure the efficiency as well as profitability. In our throughput accounting, since there is a bottleneck resources, all other resources in production and elsewhere are not bottlenecks. That means in the production process, if there is one bottleneck resource, in that case the other resources may not be the bottleneck. In that case, since production and throughput are limited by the bottleneck resources, it follows that there will be a idle capacity for all other resources. For example, this is the bottleneck resources. In that case, there may be some idle capacity by the material preparation and assembling unit, because this resources is constraining the output for the other production process. In that case, this material preparation and this final assembly, these two will face some idle capacity. That's why idle time should be accepted, because since all operation costs are fixed, idle time is not costing any money, because in our throughput accounting we consider that all other costs except the material cost should be considered as a fixed cost. In our theory of constraint, using non-bottleneck resources above the amount required for maximum throughput is wasteful. It does not increase throughput, it only increases unused inventory levels. However, output through the binding constraint should never be delayed or held up, otherwise sales will be lost. To avoid this happening, a small buffer inventory should be built up immediately prior to the bottleneck constraint. In our throughput accounting, we try to maximize the throughput contribution, as well as we try to reduce the inventory and operational expenses. Throughput accounting is based on the theory of constraints, and it is similar to the idea of marginal costing technique. And here in throughput accounting, our throughput contribution means sales minus direct material cost. In our throughput accounting, we try to emphasize throughput. We emphasize on inventory minimization. We also emphasize on cost control. And in our throughput accounting, only the material cost is the variable cost. All other factory cost should be considered as a fixed cost. Suppose labor cost is also a fixed cost for a short time. We can see there is a difference between traditional costing and throughput accounting. In traditional costing, the labor cost as well as the variable overhead cost are considered as variable cost, and in throughput accounting only the material cost is considered as variable and all other factory cost is considered as a fixed cost. In traditional costing, inventory is valued at a total production cost. On the other hand, in throughput accounting, inventory is valued with only the material cost. In traditional costing, value is added when an item is produced, and in throughput accounting, value is added when an item is sold. In traditional costing, product profitability can be determined by deducting a product cost from selling price, and in throughput accounting, profitability is determined by the rate at which money is earned. Now we are going to learn about the ratios or formula which are used in throughput accounting. In throughput accounting, we try to compare the returns with the cost, and in throughput accounting, in case of cost, all the factory costs are considered as fixed cost, as well as we can see the labor cost is also considered as a fixed cost. We can see there is a same indication. Only the material cost is considered as variable cost, except the material, all other conversion cost or all other factory cost are considered as a fixed cost. And in our throughput accounting, return means sales minus material cost. To get the return per factory hour, we divide the throughput return by the time on bottleneck resources, and throughput return can be calculated by deducting the material purchase from the sales revenue. We divide total factory cost by the time on bottleneck resources to get the cost per factory hour. This is the return per factory hour and this is the cost per factory hour. If we divide the return per factory hour by the cost per factory hour, we get the throughput accounting ratio. From the previous slide, we have learned that. What does this throughput accounting ratio indicate? We can see total throughput should exceed total factory cost, otherwise the organization will make a loss. Throughput accounting ratio should exceed 1. A throughput accounting ratio that is not much bigger than 1 is barely profitable, not profitable. The aim should be to achieve a high throughput accounting ratio as possible. Throughput accounting ratio can also be used to assess the relative earning capabilities of different products. Products can be ranked in order of priority for manufacture and sale in order of their throughput accounting ratio. If higher throughput accounting ratio, the product should be get priority for production and sale. In the same way, different divisions of a business can also be ranked based on the throughput accounting ratio. The product which has higher throughput accounting ratio should be emphasized or prioritized for production and sale. In the same way, any division which has higher throughput accounting ratio should be prioritized. The simple application of throughput accounting ratio is that the product which provides higher throughput accounting ratio than 1 is a profitable product or profitable division. How can we improve the throughput accounting ratio? Throughput accounting ratio can be increased by increasing the throughput per bottleneck hour or by reducing the operating cost per bottleneck hour, as well as we can also improve or increase the throughput accounting ratio by following ways. We can see we can increase the selling price, but we should keep in our mind that whenever we increase the selling price, there may be a bad effect on the demand. The second way to increase the throughput accounting ratio is to reduce the material cost per unit. And whenever we reduce the material cost per unit, there may be a consequence, which is quality may fall and bulk discounts may be lost. And the third way to improve the throughput accounting ratio is to reduce the expenditure on operating cost. And if we reduce the operating expenses, the consequence may be quality may fall and or error increases. I mean, whenever we are considering to apply these ways, we should keep in our mind the consequences. However, the fourth way to improve the throughput accounting ratio is to improve the efficiency and increase the number of units or product. And the fifth way to improve the throughput accounting ratio is to elevate the bottlenecks. I mean, we need to take measures so that the bottleneck resources can be elevated. For our easy understanding, there is a activity or illustration or example. From this example, we will learn the bottleneck resources as well as the throughput accounting ratio. We can see MN company manufactures automated industrial trolleys. Each trolley sells for $2,000 and the material cost per unit is $600. Labor and variable overhead are $5,500 and $8,000 per week respectively. Fixed production costs are $450,000 per year and marketing and administrative costs are $265,000 per year. The trolleys are made on 3 different machines, machine X, Y and Z. Machine X makes the 4 frame panels required for each trolley. I mean, machine X produces the panels for the trolley. Its maximum output is 180 frame panels per week. Machine X is old and unreliable and it breaks down from time to time. It is estimated that 20 hours of production are lost per month. Due to the machine X, 20 hours production are lost per month. And machine Y can produce parts for 52 trolleys per week. And machine Z, which is old but reasonably reliable, can process and assemble 30 trolleys per week. So here output is 30 trolleys by the machine Z and here 52 trolleys by the machine Y, and we need to find out how many trolleys are output by the machine X. However, there are some other information. The company has recently introduced a just-in-time system, and it is company policy to hold little work in progress and no finished goods inventory from week to week. The company operates 40-hour week, 48 weeks a year. From this information, we need to find out which machine is the bottleneck machine, I mean constraints for the production process, and other requirement is what is the throughput accounting ratio. So from this information, we can see our machine X, it loses 20 hours per month, and we know that in 1 month there are 4 weeks. So if we divide this 20 hour by 4 weeks, then in each week 5 hours. 5 hours is lost from the machine X by each week, and this 5 hours, 5 divided by 40 hours, 0.125, I mean 12.5% is lost hours by the machine X. We have divided by 40 because from the question we can see per week our operation is 40 hour per week. Since we loss 5-hour week from the machine X. So if we divide 5 by 40, this 0.125, 12.5% is lost hours by the machine X. From the question we can see the machine X produce 180 frames per week, and that since there is a loss of 12.5%, if we multiply this 12.5% with the 180, then actually 22.5 units are not produced due to the loss hour. If we minus 180 by the 22.5, 157.5, this is the actual output from the machine X. So since it's a fraction, I am considering it as 158. 158 unit is produced. 158 panels are produced by the machine X, and for each trolley we need 4 panels. So if we divide this 150 with the 4 panels for each trolley, then we will get the 158 divided by 4, 39.5. It is again fraction, we are considering it as 39. So this 39 is the output trolley from machine X. After considering the loss hour, ultimately the machine X can produce equal to 39 trolleys. And from the question, machine Y can produce 52 trolleys and machine Z 30 trolleys. So machine X 39 trolleys, machine Y 52 trolleys, machine Z 30 trolleys. So the minimum output is providing by the machine Z. So it's a bottleneck machine, limited resources. So our first requirement was to find out the bottleneck machine. We have found that machine Z is the bottleneck or constraints because it is producing the lower amount comparing to the machine X and Y, because the output is 30 trolleys. On the other hand, machine X is producing 39 trolleys, and machine Y is producing 52 trolleys. So machine Z is the bottleneck machine or limited constraint for this production process. Our another requirement is, what is the throughput accounting ratio? We already know the formula about throughput accounting ratio. We divide the return per factory hour by the cost per factory hour, and return per factory hour is calculated with this formula. Material purchase is deducted from the sales revenue and it is divided by the time on bottleneck resources. Cost per factory hour is calculated as total factory cost divided by time on bottleneck resources. So to calculate the throughput accounting ratio, we divide the return per hour by the cost per hour. That means we need to calculate the return per hour and cost per hour. From the question we can see our sales revenue is 2000 and material cost is 600 per unit. And since we know that to calculate the return per factory hour, we deduct the material purchase from the sales revenue. Here our material cost is 600 and revenue is 2000. If we deduct the 600 from the 2000, we will get the throughput return, and there are 30 trolleys. It is the bottleneck output. So after multiplying these 30 trolleys with the 1400, we will get the 42,000. From the question we can see our normal operating hour is 40-hour week. If we divide this 42,000 with the 40 hour, our actual return per hour is 1050. So our return per hour is 1050. And from the question we can see labor cost 5500 and variable overhead 8000, and there are other fixed production cost we can see 450,000 per year. This is the per year cost. but we need to find out this per year cost into a per week cost. From the question we can see there are 48 weeks per year. If we divide this 450,000 by the 48 week, we will get the 450,000 divided by 48, 9,375. This is the fixed production cost per week. So 9,375 is the fixed production cost per unit, as well as we need to add the labor and variable overhead plus 5,500 plus 8,000. So this is the total factory cost. Out of this 22,875 total factory cost, 5,500 is labor cost, 8,000 is variable overhead cost, and 9,375 is the other fixed factory cost. Total 22,875 is the total cost per week. And we can see from the question, per week there are 40 hours. If we divide this 22,875 by the 40, our cost per hour is 572. Our return per hour is 1050 and our cost per hour is 572. To calculate the return, we have deducted the material purchase cost from the sales revenue. Then we multiplied these 30 trolleys because this is the output from the limited resources. Ultimately there are 42,000 output, and by dividing the 40 hour per week, we get the return per hour, which is 1050, and our cost per hour is 572. And if we divide this 1050 with the 572, we will get the throughput accounting ratio, which is 1.84. If I show you in the calculator, 1050 divided by 572, this is the 1.835 or 1.84. So our throughput accounting ratio is 1.84, which is higher than 1. So according to our interpretation of throughput accounting ratio, when the throughput accounting ratio exceeds 1, in that case the product could be considered as a profitable product because it is producing throughput accounting ratio which is higher than 1. Here the throughput accounting ratio is 1.84. I mean our trolley production is a profitable production, although there is a bottleneck resources due to the machine jet. So we calculate the throughput accounting ratio by dividing the return per factory hour by cost per factory hour, and when the throughput accounting ratio exceeds the 1, then we can say that the product which producing the throughput accounting ratio higher than 1 is a profitable product, or any division which is producing throughput accounting ratio higher than 1, then that division is also a profitable division. In this way we apply the throughput accounting ratio in our management decision. Thank you.